As part of my consulting work, I help entrepreneurs prepare to seek angel or venture capital investment. That means helping with business plans, pro forma financials, pitches and pitch decks, and with figuring out what to expect in a term sheet and what all of the technical jargon means. Now, I'm not a lawyer, and if you're about to accept an offer from an investor, you really need to go over all of the terms with a lawyer who specializes in this type of deal. However, there is one term that comes up over and over again with my clients that new entrepreneurs are not familiar with and don't understand, and it has a gigantic impact on the payout an entrepreneur can get when his or her company either fails and closes up shop or succeeds wildly and there's a profitable exit, and that is the liquidation preference. Again, if you're looking at a real deal and you're about to sign some paperwork, go see a lawyer. However, here's a basic rundown of what a liquidation preference is and how it affects an entrepreneur. When you raise money from a VC, the VC will almost certainly expect to receive preferred stock as opposed to common stock. Preferred stock is thus named because the holders of preferred stock receive preferential treatment if there's a liquidation event at the business. A liquidation event would be something like a sale of the business, a bankruptcy, or a dissolution of the business. Now, one of those bits of preferential treatment that preferred stockholders receive in one of these events is the liquidation preference. A liquidation preference basically means that the investor who now holds preferred stock will get his or her investment back before the company's assets are divided up amongst all of the shareholders. So, if an investor puts in $1 million for a 20% equity stake with a 1x liquidation preference, and then the company sells for $10 million, that investor first gets his or her $1 million out, and then just the remaining $9 million is what's divided amongst the shareholders based on percentages. So, that same investor will get an additional $1.8 million for a total of $2.8 million. Without the liquidation preference, he or she would have just received $2 million, or 20% of the $10 million sale price. The same goes if the company ends up selling at a lower valuation or closing its doors. And this is actually why the liquidation preference came into existence, to protect the investor in case of such a loss. So, if the investor put in that same $1 million for 20%, but then the company sold for just $2 million, without a liquidation preference, the investor would only be entitled to $400,000 and would have to just take that loss. With a 1x liquidation preference, he or she would receive the $1 million investment back, and then the remaining $1 million would be split amongst the shareholders. Without a liquidation preference, it would be possible for an entrepreneur to make money tanking a company. An investor may put in $1 million for 20%, and a year later, the entrepreneur who owns 80% could decide to dissolve the business and take 80% of the money that's left, essentially screwing the investor. A liquidation preference seeks to more closely align the entrepreneur's interests with the investor's. Liquidation preferences can also come in multiples. The examples above showed 1x liquidation preferences, but investors could also say they want 1.5 times, 2 times, or even more of the invested money back first before divvying the rest up by percentages. This is sometimes referred to as a super liquidation preference, and it's absolutely not the norm, so be incredibly wary if you see this in a term sheet. As you can see, the liquidation preference can drastically alter the returns that an investor or an entrepreneur is entitled to, so it's incredibly important to understand what you're agreeing to before signing on the dotted line and taking an investor's money. While there are many items in a typical term sheet that can be tricky and easily misunderstood, the liquidation preference is the one that comes as the biggest shock to the vast majority of my clients. So I hope that this helps to provide a bit of clarification. Did you find this video helpful or fun? Then share it with a friend who you think would benefit from the dish, and don't forget to follow me on Twitter and Facebook and subscribe to my channel on YouTube so you never miss any of the latest tips, tricks, and tutorials to help your business grow. And you get to see my adventures through the wide world of entrepreneurship and how I use the freedom running my own business gives me. Also, remember to head over to CateCosta.com so you can get in on the conversation about how to build your business to success so you can live your life your way.